Taking a look at net working capital, this one's pretty important, so it's got a whole dedicated slide here. Net working capital is just going to be your current assets minus your current liabilities. And we're going to talk about different situations in relation to how it changes, things to look out for as the auditor. And beginning off here, an increase in the current ratio of current assets, let's say cash, right? Whenever we say current assets, we mean cash, say if you have gold on hand, right? Accounts receivable, inventory. Let's just say cash. Just think of the same account over and over. Let's say cash to non-current assets such as investments, PP&E, anything like that would be indicative of an increasingly conservative working capital policy. Now, what does that mean? It means that you as a company, when you're holding cash doesn't do anything. It's not earning you really much interest, right? You got pretty low interest rates for keeping your cash with a bank. If you use your cash and lever your cash to buy new equipment, to produce new products, or to buy investments, those will generate cash flows, will generate returns for you. But what a conservative working capital policy means is you're keeping more cash on hand, fully knowing that the cash isn't doing anything for you. It's not earning you money. But what it's doing is it's letting you to be not highly levered to be able to pay down your debt if you ever need to be able to pay it down. Now, this is due to the company maintaining more cash and liquid assets. Similarly, if you have a lot of inventory on hand, if you have a lot of AR, a lot of other current assets that you can turn to cash quickly, that's going to help you to have a more conservative policy, meaning you're not taking risks by leveraging, investing your money into non-current assets. A more conservative working capital policy combats high leverage. Now, leverage is not a good thing. It's not a bad thing inherently. It's just something to mitigate when it comes to risk. A working capital financing policy that subjects the firm to the greatest risk of being unable to meet the firm's maturing obligations. So let's just dissect what this means, these words here, right? The greatest risk to be unable to meet the firm's maturing obligations, the debt that's becoming due. Let's say your credit card is due at the end of the month. If the closer we get to the end of the month, that's a maturing obligation, is a policy that finances permanent current assets with short-term debt. That's the greatest risk. Now, what does this mean? Short-term debt is the riskiest. Think credit card debt. Credit card debt is short-term. You're borrowing it for a month. Got like something like 27% interest rates. I don't know. I don't pay credit card debt. I mean, I'm very conservative when it comes to spending money. I don't want to spend money. But when it comes to that, right, that is very risky because you're buying permanent assets that are likely hard to sell and you are financing it through short-term debt. Short-term debt is considered to be the most risky form of debt. When you're buying permanent assets, whether it's fixed assets, whether it's long-term assets, machines, equipment, you want to use long-term debt, which generally has better rates. You're maybe collateralizing it, subjecting it to debt covenants, anything like that's going to be much better than short-term debt. Like I say here, the situation is reminiscent of taking out margin or leverage to purchase securities. Don't recommend doing that unless you're, incredibly certain of what you're doing. All right, not here to give financial advice. Now, to understand the effect of any transaction, such as issuing stock, long-term debt, anything like that, think about the journal entry and its effect on current assets and current liabilities. You could have questions where it says the entity issued more stock or issued more debt. What's the effect on multiple ratios? Certain ratios may not have any effect, like it might not affect the ratios at all. Think of the journal entry. You could even plug placeholder numbers in to see the effect of a transaction on particular ratios. Very commonly asked questions. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.